I try to differentiate this crypto channel. I try to talk about things you won't see in other videos. I try to invoke some thoughts you might not have had about Bitcoin and about crypto in general. And so in this video, I'm going to talk about an approach that is rather controversial. It's an approach that is completely normal in other asset classes, but in crypto it's pretty much unheard of. But let's take a step back. Let's first set the scene. Let's have a look at the long-term performance of Bitcoin and how the holders evolve over time. This here is Bitcoin's long-term price chart. It starts in 2011 when it was just a few cents all the way to today. And what we see here with this orange line, that's the percent of Bitcoin that has not moved for the last 1 year. So minimum holding duration of 12 months. And we see how this fluctuates. It tends to go up when the price of Bitcoin goes down, and it tends to go down when the price of Bitcoin is rallying. In other words, this cohort of the market seems to do the right thing. They're buying the bottom, they're selling the top. And in the last 1.5 years, they tended to rather sell. Again, because Bitcoin made a 2.5x during that time. But 1 year seems to be an arbitrary number. Why don't we look at this for 2 years? Now, this is quite interesting. The 2-year line is less volatile than the 1-year line. It tends to go up over time, but yes, we also have selling during bull runs. The selling, though, during a rally seems to be less aggressive than the buying during a bear market. When the price is low, when Bitcoin is just at 20K or so, this cohort enters aggressively. And so this effect gets stronger and stronger the longer we go in the duration. This is now 3 years. Now, why are we even talking about this? We're talking about this in order to figure out the long-term structure. How does the market over time evolve? And what kind of long-term investment strategies can we actually derive from that? The wallets that have held Bitcoin for at least 3 years, they rarely sell. They only sell during extreme circumstances. So over here, when Bitcoin did a 10x over the span of only half a year, and when it already came from $200 all the way up to $1,000. So there was a 5x that already happened, and then subsequently when another 10x happened, that's then when those holders sold. But outside of those extreme situations, the holders with a 3-year and longer time horizon don't offload their Bitcoin. This is the regular pace of accumulation. And then when we extend the minimum holding duration beyond a typical crypto cycle, right, the 4-year mark, once we go to 5 years, we do not see any selling whatsoever. If you don't ride the cycles, if you just buy Bitcoin for the long term, then there is no net selling of that cohort. This is going up all the time. Now, the Bitcoin supply, the number of Bitcoin during that time, of course, also went up. Right? There is Bitcoin mining. New Bitcoin hits the market all the time. But this is a relative chart. How much percent of the currently circulating supply is in that cohort? So the cohort acquires Bitcoin faster than Bitcoin mining happens. It's currently at 30%. 5 years ago, it was at 22%. 10 years ago, it was at 10%. Now, this is just on-chain metrics, right? We don't know if those are long-term holders or if those are people that actually lost their Bitcoin. Probably a mix of both. But this chart alone shows why Bitcoin has to go up long-term. The circulating supply shrinks over time because there's Bitcoin that gets lost and there's Bitcoin that's held by holders that simply don't move their Bitcoin. The investment horizon is beyond 5 years. It's actually quite interesting to think about this deeply. 5 years as an investment horizon is long for Bitcoin, it's long for altcoins, but it's already super short for any other asset class. It's short for stocks, it's definitely short for property as well and for precious metals. For Bitcoin, we are already among the super patient investors that weather all the storm. Now, what kind of implication does this actually have when the supply is shrinking constantly when we've got a 5-year time horizon? I think the implication is that the likelihood that Bitcoin will be at a lower price in 5 years from now is extremely, extremely low. It could be compared with the property market, right? When you buy a house now and you've got a 30-year mortgage, the likelihood that that house will be lower in value 30 years from now is also very, very low. For Bitcoin, things simply go a bit faster. And this is also where I want to make now the comparison, the unconventional thought that most people don't have. In the property market, it's completely normal to take out a huge loan to get into massive debt, maximum debt that somebody can afford in order to get this one single asset to then pay off this asset over the long term, over say 20 or 30 years. For crypto or for Bitcoin, that's extremely uncommon. Instead, this is the common approach. This is what everybody is suggesting. Dollar cost average into Bitcoin, right? If you don't want to speculate with the asset, if you just want to get exposure to the asset, then just buy a little bit every single month, buy the dips, buy the tops, buy whatever, because long-term Bitcoin appreciates. That's the common strategy. And yes, it does work. But is it optimal? What we see over here is a simulation of dollar cost averaging. So we are buying into Bitcoin, this time not for 5 years, but for 4 years. Unfortunately, I can't select 5 years over here. And we are buying $1,000 every single month. So what we purchase, the purchased or the invested amount, is this line here in blue. It's a step function that goes up by $1,000 every month. The green line is the Bitcoin price. And the orange line is what we would have gotten at the end of all of that dollar cost averaging. So over 4 years, we invested 49K and we ended up with a portfolio of 140K. Or in this case, 1.3 Bitcoin that got bought over the time. Now let's take the same approach for crypto that is super common in the property market. So let's take out a loan, pay off that loan over time and invest this all in a lump sum at the very beginning. So instead of investing those 49K over all of those months, we are just paying off a loan worth that value with a monthly rate of $1,000. Bitcoin at the time was at 33K. We went up a little bit, then came the massive crash to 16K. But yeah, at 33K, if we invested 49K, we would have gotten 1.48 Bitcoin. We would have purchased more Bitcoin than what we got after all of that dollar cost averaging. We would have outperformed by roughly 10%. And this is assuming the worst case scenario, right? This is assuming that we are buying pretty high, close to the all-time high, and then we go through a massive correction. Of course, ideally, we want to rather buy low when we invest lump sum. In this case, we did not buy that low. And so it's very likely actually when we do the lump sum investment and we just pay off that loan over time that we are going to be ahead of the person that just dollar cost averages. Now I understand how it can feel quite wrong to take out a big loan in order to buy Bitcoin with it. But that's really just a feeling. Mathematically, it's not that bad of an idea. People do this with property all the time with much higher amounts. Is your single house, the one asset, really that much safer of an investment versus Bitcoin that's adopted globally? Over the very long term, there can really only be one direction for the Bitcoin price. And that is up into the right, because the inflation, the supply inflation of Bitcoin goes down, and it's already with 0.8% per annum extremely low. And as we've discussed with the long-term holders, they eat up that supply very, very quickly. So Bitcoin's base expands by 0.8% very soon, only by 0.4%. And at the same time, the money supply expands by 6.8% per annum. So just because of that delta, the US dollar price of Bitcoin has to go up as the monetary base expands so fast, and as there's more and more dollars for fewer and fewer Bitcoin, the price has to appreciate. It's just logic. Another way to look at this is, would you feel comfortable buying this asset over here? Do you want to hold this here long term? Because this is just the inverse of the Bitcoin price. This is the value of a US dollar measured in Bitcoin. The US dollar is losing value against Bitcoin. It's losing value against everything, against houses, against gold, against stocks, but especially against Bitcoin. At the same time, we've got all the long-term accumulation by Wall Street and by the Bitcoin treasury companies, right? There was accumulation of 1.1 million Bitcoin, more than 5% of Bitcoin supply in the last 1.5 years alone. And it appears as if this chart is even accelerating, despite the price going up all the time. So the adoption of Wall Street is faster than the Bitcoin price appreciation. Now, all of this talk is actually not just pure theory. I have done this myself. I took out a loan of 1 year worth of my salary at the time. I was employed at the time. 1 year worth of salary to buy Bitcoin. But yes, I did time the market. I didn't just do this on a random day. This dollar cost average simulator is just a random day where it started. There was nothing particular about the 30K mark. But there are ways to potentially find extremely cheap prices when it does make sense to go extremely risk on and take out that loan. What we've got over here is the Sharpe ratio of Bitcoin. So Bitcoin's return relative to its volatility. And when this is low, at -1, potentially even -2, we want to get in massively. This is the time where we subsequently have our multiple X returns in Bitcoin. Unfortunately, we are not at that place right now. Now check this out. This is the realized hodl ratio. This looks at the trading of short-term holders versus long-term holders. When it's mainly short-term holders that trade Bitcoin, then this is high. When it's mainly long-term holders that buy into Bitcoin, this is low. And we want to buy whenever this is low. Again, this gives us nice cycle bottoms. In theory, this looks all super simple. In practice, it's really not. There are two effects that work against us. The first is mass psychology. When the price of Bitcoin is low, when it has crashed, say 60 or 70% from the all-time high, then all of the media will say that Bitcoin is dead. There's usually a good reason why Bitcoin is so low. Maybe FTX, right, a big centralized exchange, went belly up. Maybe the IPO boom has completely disappointed and all of the altcoins, they went close to zero. Maybe the main use cases of Bitcoin suddenly shut down, right? It was Mt. Gox and Silk Road in the very early days. When indicators like this flash green again, there is a good reason to not own Bitcoin. And you have to ask yourself, would you be comfortable taking out a loan in Bitcoin if the news are completely negative? Say if Binance was to go bust, or say if BlackRock can't buy Bitcoin anymore and has to dissolve the ETF, or let's say if Michael Saylor and MicroStrategy suddenly have to liquidate their Bitcoin. If there's something like this happening that causes a massive decline in Bitcoin, would you be okay to buy Bitcoin with an entire year worth of salary, take out a loan and pay this off over the next years? If the answer is yes, then you will get rewarded handsomely. The answer is no, you won't take advantage of the opportunity. And so why do I make a video like this now and not when Bitcoin is already very depressed? It's because at the time when Bitcoin is so low, nobody wants to hear the message. It's much better to get mentally prepared about this right now. Think about this deeply. When everything looks red, is your conviction strong enough to buy into Bitcoin heavily, potentially even with debt? If your conviction in the asset is not strong enough, then maybe think about what could you potentially learn? What are the kind of information sources that would turn this around? Where you could learn enough that you can be in the end contrarian, that when everybody is panicking, that you can still stay cool, because that's what gets rewarded. There's already one data point that you actually might be the person that's able to pull it off. Because right now, today, as you're watching this video, the attention on crypto is not necessarily very high. This is the number of search queries for Bitcoin. And everybody will ask about whether or not to buy Bitcoin when it's close to all-time highs, when it has doubled in a short time period. Everybody searches for it. That's when everybody asks, should I buy Bitcoin? And that's when you might consider offloading some. You are already part of the minority when you're watching crypto videos right now. The vast majority of people are not interested in crypto at the moment. The only reason why Bitcoin is so close to the all-time high is institutional buying. It's purchases by Wall Street. It's not yet the masses that came in. And so this gives me hope. You're very likely an above average investor since you're sticking around. And so now the big question is, will you just dollar cost average into Bitcoin, or will you actually have what it takes in order to buy the bottom heavily when everybody else is giving up? Really, in this current situation, I think it's better to work with the general market structure instead of trying to find the needle in the haystack. Yes, there are a few altcoins that made profit in the last year. This is the smaller altcoins, the performance in the last year. There are a few green bubbles over here, but chances are, especially when you've got a diversified portfolio, that you are down. Because crypto is highly correlated, so assets do tend to move in the same direction at the same time. But there is long-term underperformance of the altcoins. What we've got over here in green is Ethereum, and in white we've got the altcoin. Both lines go up and down at the same time, but the white line tends to do worse long term. And there's a good reason for this massive underperformance of most tokens. And that's over here. It's shown on Tokenomics.ai. That's a website that tracks various altcoins. And just have a look at this. WorldCoin and Trump sees a lot of unlocks tomorrow. 5 million worth of unlocks. Solana has 10 million, but Solana is overall much larger in market cap anyways, so it doesn't matter too much. But WorldCoin and Trump doesn't have as much usage. And so, surprise, surprise, WorldCoin relative to Ethereum long term tends to go down. And Trump relative to Solana doesn't look that different. When the early investors and the insiders and the team is getting more and more tokens over time, and the project itself isn't growing that much anymore, we see constant underperformance. But it's really about the relative valuation, right? It's relative to Ethereum or relative to Solana. It's not just in US dollars, because sometimes when there's a rally, the altcoins go up as well. It's just the ratio of the small altcoin relative to the larger market-leading cryptocurrency that goes down over time. And so there's a way to make money with this. We bet on falling prices of all of those crap coins, while at the same time we bet on rising prices of Bitcoin, Ethereum, and Solana. So we're winning on one end, we're losing on another end. We're just playing the delta, and we can make money by basically turning this chart around. Everything that's red here can turn into green. Everything that's green can turn into red. And then all of a sudden, we've got the odds in our favor. We're not trying anymore to pick the needle in the haystack. We're just betting on the haystack continuing to do what it's always doing. And so have a look at how our community is making money with this. If you've got proper stop losses in place, if your risk management is on point, individual trades can make massive returns. And so that's why I tell everybody that considers following this strategy to first watch the very first tutorial video here. Risk management with relative valuation bets. It's 28 minutes. Once you've watched that, potentially also with this video over here, you should be good to go. There are tutorial videos on all kinds of topics, but again, even though it's not a sexy topic, risk management does matter. Because even though the odds are in our favor with this strategy, you don't want to lose your shirt just because you've got one losing trade. Just because 1 out of 10 trades fails doesn't mean that you can use unlimited leverage without stop loss, because then this single trade that goes wrong will crush the entire portfolio. Risk management is super, super important. So feel free to learn more. It's currently $125 US per month. You will lock in that rate. So when I increase the price in the future, you will not be affected by that. Only new signups will be affected by higher prices. A link to premium will pop up over here. Just click on that. It will lead you directly to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.